or basically an investment in what? An investment in debt instrument. Yes. So I want us to have a discussion on this financial liabilities before we take a short break, and then we come back to do a question. So if we are done basically with what we have up there, I think we can move and discuss on this. Yes. So financial liability. What is a financial liability? A financial liability, basically, we can say that this is a contractual obligation. This is a contractual obligation to do what? To pay cash. This is a contractual obligation to do what? To pay cash. So here, an entity or basically a company has entered into a contract, and in that contract, the company has an obligation to pay what? To pay cash. Now, generally, financial liabilities, these are the debt instruments which have been issued by the company. So these are the debt instruments issued by who? By the company. The debt instrument, e.g. debentures, e.g. bonds, which have been issued by who? Issued by a company. Issued by who? By a company. So therefore, if you come across a question and you're told company X here, for example, issued debentures, the company X issued bonds. So to this company, this is a financial what? Liability. And therefore, you need to differentiate between financial assets and financial liability. So financial asset is whereby a company will have invested or a company will purchase debentures or what? Both. So if you invest, you purchase both or debentures, to you is an asset. But if a company issue debentures or if a company issue both, to the company is a financial liability. To that company is a financial liability, because once a company issue both, once a company issue debentures, the company has an obligation to pay cash. Now, which cash will our company be required to pay here? Assuming our company issued both or basically debentures having a life of 3 years. It basically means that this company, over the next 3 years, at the end of each year, our company has to pay interest. Once the 3 years come to an end, the company will have to do what? To redeem those particular debentures or bonds in terms of paying back the principal amount. In terms of paying back the principal amount. So therefore, here you can see our company has entered into a contract, and in that contract, the company has an obligation to do what? To pay cash. Yes. Now, in this case, we have two categories of financial liabilities, but majorly we will discuss on one, because that is the one which is very common. So we have a financial liability at fair value through profit or loss. So basically, these ones are not common. I will not even discuss that. But basically, just know we have two categories. And then number two, we have financial liability at amortized cost. These are the common type of what? Of financial liabilities. The common type of financial liabilities which are issued by the company. The financial liabilities at amortized what? At amortized cost. Now, these are basically the debt instruments which are issued by the company, e.g. debentures or bonds, which are supposed to be redeemed after a number of years. In other terms, we can say that these are the debt instruments which are issued by the company. They have a fixed rate. A fixed rate means, for example, a company, you can be told a company issued debentures or basically bonds having a life of 3 years. Having a life of 3 years means that those debentures or those bonds can only be redeemed by the company at the end of the 3rd year. Can only be redeemed by the company at the end of what? The 3rd year. They have a fixed life. They have a fixed what? Life. So therefore, that's why we are saying that these are the common type of what? These are the common type of financial liabilities, which are basically issued by what? By the company. Now, what you then need to know, as far as these financial liabilities are concerned, are two things. The amount for initial recognition, how do we determine the amount for initial recognition, and how we determine the amount for subsequent measurement. How do we determine the amount for initial recognition, and basically the amount for subsequent measurement. So when we talk about the amount for subsequent measurement, we are referring to the amount at which these financial liabilities will be recorded in the company's statement of financial position at the end of each year. Now, the amount for initial recognition, or once the company issued this debt instrument having a fixed value, they are initially recorded in the company's books of account at what? The fair value of purchase consideration. The fair value of purchase consideration received. The fair value of purchase consideration received. How much amount was received by the company? Fair value of purchase consideration received minus any transaction cost. Minus any transaction cost. Like in this case, you can be told a company issued debentures, and those debentures which were issued, they were issued, or the company issued them at an amount of 200 million. So 200 million, the company issued shillings 200 million debentures, but during the issue, the company incurred a transaction cost of maybe 2 million. This is the transaction cost which was incurred by the company. So the amount for initial recognition will be equal to the fair value of purchase consideration received. The amount the company received is 200 million. We minus the transaction cost. The transaction cost is the cost incurred in the year issue, which is 2 million. So the amount for initial recognition, therefore, will be 198 million. So the purchase consideration received minus any transaction cost. Then, what about the amount for subsequent measurement? The amount for subsequent measurement, this one is equal to the amortized cost. This one is equal to the amortized cost. Now, for us to be able to determine this amortized cost, we must prepare something called the amortization schedule. We must prepare something called the amortization what? Schedule. The amortization what? Schedule, similar to what we have done here, although we will be able to see there is a slight difference because what we are dealing with here is a financial liability. What we have dealt with in the other question was a financial asset. We will be able to see there is a slight difference in terms of how we prepare the amortization schedule in case of a financial asset and also in case of a financial liability. So I want us to do a question on this once we come back after a short break. There was a question which was examined on this in this sitting, the sitting of April of 2025. If you go to those papers for FR, the papers for FR, let me share those papers in the class WhatsApp group. So we have these questions here, April of 2025. And this was specifically question number 4. 4B. Question 4B. So this is from your papers for FRA. So I want us to take a short break of how many minutes? We can just take a short break of just 5 minutes. 5 minutes. We come back. Make sure you have that question with you. The question for April 2025. April 2025 question 4B. So let's come back after the short break of 5 minutes and then we look on that question. Yes, so I want us to proceed. Let's proceed. Let's continue so that we wind up with this particular question here. A small one, but you'll also be able to see that it involves some workings here. So what have we told? I hope you have that question with you. Abdinasil, do you have that question with you? Jeffa, Stephen, do you have that question with you? Do you have that question with you? Ridian, are you there? Okay. So what have we told here? A small question, question number 4B. It reads, on 1st January 2021, Trades Limited issued shillings 20 million. Issued shillings 20 million, 8% raw notes at a discount of 5%. The issue cost amounted to shillings 1 million. Then in paragraph 2, you're told the raw notes were redeemable on the 31st of December 2024 at a premium of 1,130,000. The effective interest rate will be, or therefore, is 12.5%. So we are told with suitable calculations, illustrate the accounting treatment of the above transaction from 1st January 2021 to 31st of December 2024 in the financial statement of Trade Limited in accordance with IFRS 9 financial instrument recognition and measurement. Round your answers to the nearest 1,000, to the nearest 1,000. So we are told this company, first of all, which is called Trades Limited, issued shillings 20 million 8% roll notes. So we have said if a company issued debt instrument, roll notes and debt instrument, basically this is a financial liability. And actually you have said that because they have a fixed rate, because you can see that these roll notes will be redeemed on 31st of December 2024. So these are debt instruments issued by the company. They have a fixed rate. So basically, what that means is that these are financial liabilities at amortized cost. So we can say these roll notes. This is basically for your revision is not required by the examiner. Here we can say these roll notes issued by who? Issued by Trades Limited is what? Is a financial liability at what? At amortized cost. Is a financial liability at amortized cost. Now, having known that, we need to determine amount for initial recognition. Amount for initial what? For initial recognition. Remember, in this case, were issued on which date? They were issued on 1st January 2021. 1st January 2021. 1st January 2021. Now, for us to be able to determine this, you must remember the formula which I've given you. And we have said that the amount for initial recognition is equal to the fair value of the purchase consideration. The fair value of purchase consideration which was received minus any transaction cost, minus any transaction cost, minus any transaction cost. How much amount was received less the transaction cost? Are we given this information? Yes. Let's go back to paragraph 1. And basically, we're told that on 1st January 2021, this company issued shillings 20 million. This 20 million is the face, the nominal or the par value, 8% loan note at a discount of 5%. At a discount of 5%. In this case, you can see the loan notes issued, they had a face value of 20 million, but were they issued at 20 million? No, we are told they were issued at a discount of 5%. So therefore, the amount received, the purchase consideration received by our company here, this one will be equal to 95% of 20 million. 95% of 20 million, because they were issued at a discount of 5%. This is the fair value of purchase consideration received. And then to this, we minus the transaction cost. Do we have transaction cost incurred by our company here? Yes. We are told in the first paragraph, the last sentence, the issue cost amounted to 1 million. There was an issue cost. The issue cost is the transaction cost, which is basically what? 1 million. And I think what we need to do, equally, if you check on the requirement, we are told to work with our figures to the nearest 1,000 of shillings. So just like what you have done in the other question, we will work with all our figures in 1,000 of shillings. We omit the last 3 zeros. Yes. So we take 95% of this, and then we minus the transaction cost. We minus the transaction cost. This will give us what? 95% times 20 minus 1,000, and that will give us what? That will give us 18 million. That will give us what? 18 million. This is basically the amount for initial recognition. In this case, you make entry. So this amount, how was it supposed to be accounted for by our company? So this case, our company received the money. So the amount, this is the money which was received by the company after issuing roll notes. So the company debited that in the bank. The amount was debited in the bank and then credited in a liability account called the financial liability at amortized cost. This is basically account which was credited with the amount which was received. Having determined the amount for initial recognition, we need to move and basically for subsequent measurement. For subsequent what? Measurement. Remember, this amount for subsequent measurement is basically the amount at which these financial liabilities, these roll notes, will be recorded or was supposed to be recorded in the company's statement of financial position, I think over the period of four years. So this, if you can be able to recall, we have said the amount for them is always equal to the amortized cost. Is always equal to the amortized what? Cost. And actually, we have said that this amortized will have, or actually, we're going to determine this amortized cost by basically preparing something called the amortization schedule. So that is basically we prepare the amortization schedule. So we need to determine the life of these raw notes. In paragraph 2, I think, in paragraph 2 of our question, we are told the raw notes were redeemable on 31st of December 2024. They were supposed to be redeemed in on 31st of December 2024. Remember the date they were issued. They were issued on that date. They will be having a life of how many years? 2021, 2022, 2023, 2024. They have life of 4 years. So we need to prepare the amortization schedule for those 4 years. We will have, therefore, a column for years. Basically, the first year will end 31st of December 2021, the other one 31st of December 2022, the other one 31st of December 2023, and 31st of December 2024, like that. Then our next column here will be for the amortized cost at the start of the year, the AC at the start, and remember all our figures are in thousands of shillings. The next column here will be for the interest, but basically here, this is an interest expense. If you can recall the other question, for financial asset, we had interest income. So once the company invests, the company receives or should recognize interest income. But once a company has issued raw note, the company should recognize interest expense. Now, this one will be computed equally using the effective interest rate. Are we given the effective interest rate in our question? Yes. In the last paragraph, we are given the effective interest rate. In the last paragraph, the last sentence, which is basically 12.5%. Then we have the next column here. Will it be for the cash received? No. Our company has issued raw notes, so our company will be paying some cash. And actually, to compute this one, just like what you have done in the other question, we will take the coupon interest rate. We multiply that with the face, or basically with the nominal value of this raw note. I hope you can be able to remember the nominal value. Who can tell us the nominal value for this raw notes which were issued? Jeffa, Felix, Stephen, Lilian, what is the nominal value for this raw note? It's similar to the other question. Similar to the other question which you have done for the financial asset. Yes. So this is basically the face or the par value. The face, the nominal, or the par value. So this will be equal to the coupon interest rate times 20. And then finally here, we have the column for the amortized cost at the end of the year. That is basically balance carried down. And also remember all our figures here are in thousands of shillings, like that. All figures are in thousands of shillings. So you can see there is no much difference. So the only difference is that in case of a financial liability, here we have interest income. In case of financial asset, here we have interest income. In case of financial liability, here we are having cash paid. In case of financial asset, we are having cash received. That is the only difference. Sawasa? Yes, that is the only difference. So what do we start with here? We start with the amortized cost at the start. Just like the other question, this is the amortized cost at the start, which is basically what? 18,000. So then we compute interest, which will be 12.5% of that. So let's get that one. 12.5% of 18. And that will give us what? That will give us 2250. The cash to be received, I've said we take the coupon interest rate. The coupon interest rate is what we have in paragraph 1. Coupon interest rate in paragraph 1 is given as what? Is given as 8%. So this one will be 8% of the face value. The face value is this one, 20. 20. And basically this will give us what? That will give us what? That will give us what? Yes, that will give us 1600. So this is 1600. And basically, just like what you have done in the other question, to determine the amortized cost at the end, we will take this plus this minus that. The same with what you have done in the other question. So what do we get? We're getting 18 what? Is it 18,650? Yes. So that now would be the opening balance here. 18,650, we get 12.5% of that. So you're getting what? Yes, to the nearest whole number 23, 31. This remain the same. Minus 1600. And basically, what are you getting here? 19. That's what you're getting? 19,381. Yes. So that will be the opening balance here. 19,381. Interest being 12.5% of this. So which will give us 24, 23. 24, 23. So these remain the same. 19,381 minus 1600. And that will give us 204. Yes, 2204. Is that what you're getting? And basically that will be the opening balance here, 2204. Yes. So we get the interest, which will be 12.5% of that. And that is 25. Now, at the end of year 4 here, they will be redeemed. They will be redeemed. So the amount to be received here, will be equal to the coupon payment, this one, the coupon payment over 1600 plus the capital repayment. So what are we told in relation to the redemption? Let's go back to our question here, specifically paragraph 2. Paragraph 2. We are told in paragraph 2, the loan notes will be redeemed at the end of 2024 at a premium of 1,130,000. So the amount to be paid here will be equal to the nominal value, this one, plus a premium of 1130, plus a premium of 1130. Is there any difference with the other question which you have done? No much difference. No much difference, because even in the other question we had a premium. We have taken the nominal plus what? Plus the premium. The amount to be paid here, therefore, will be 16, this one, the coupon payment plus the capital repayment. And basically this will give us 22,730. So once we compute this one, basically that one should be 0. Should be 0. Should be 0. Should be what? Should be 0. Sasa? Yes, yes. Now, having that, we now need to prepare the financial statement extract. The financial statement extract. The financial statement extract. And we will start by preparing the statement of a profit or loss extract. The statement of profit or loss extract. Basically, we show what was supposed to be recognized here over the period of 4 years. Over the period of 4 years, 31st of December 2021, 31st of December 2022, 31st of December 2023, 31st of December 2024. And basically, our figures here are in thousands of what? Of shillings. So basically, I've said what our company was supposed to recognize here is this one. And you can see this is an expense. So this interest expense was supposed to be recognized here as what? As an expense. Other expenses, our company was supposed to recognize interest expense. And this interest expense, in other terms, we can also refer to this as a finance cost. Finance cost. The finance cost for the first year is 2250. For year 2 is 2331. And basically for year 3 is 2423. And finally is 25. So this is what was supposed to be recognized in the statement of profit or loss as an expense. Finally, we prepare what? The statement of financial position. Statement of financial position still extract. Statement of financial position extract. And remember, we have said that these loan notes which were issued by our company, these are liability. This is what? A liability. So basically, remember you need to prepare these for 4 years. For 4 years. 4 years here. 4 years like that. And also we need to indicate that our figures are in thousands of shillings. Yes, now this financial liability amortized cost to the company is a liability, actually a non-current liability. A non-current what? Liability. So under the non-current liabilities, our company here was supposed to recognize something called the financial liability. The financial liability at amortized cost. Amortized cost. And actually, this one will be recognized here as this amortized cost. The amortized cost at the end of year 1 is this one, 18,650. Year 2 is 19,381. Year 3 is 20,204. And basically at the end of year 4 is what? Is 0. Is what? Is 0. So basically this, what now the examiner is requiring, this financial statement extract. This financial statement extract. And basically by doing that, you get how many marks? You get 8 marks. You get 8 what? 8 marks. You get 8 marks. So that's basically how we account for these financial liabilities. That's how we account for the financial what? Liabilities. So therefore, these are some of the questions we are likely to come across as far as that topic of financial instrumental are concerned. I hope you can see there was a question coming from this topic on compound financial instrument, a question we did in our previous class. You also likely to come across a question on financial assets, what we did at the start of this session, and also you're likely to come across a question in relation to the financial liability. So what you just need to do, can you try to redo those particular questions again on your own, and you try to identify the difference between financial assets and basically financial what? Financial liabilities. But basically now that brings us to the end of that topic on financial instrument. It basically means that once we meet now in our next class, which will be next week, basically we are moving to a different topic. We will move to a new what? To a new topic. So therefore, for today, I think we will stop at that point because I know you have another class from 4. I want you to have just a short break before the next class starts. So any question before we wind up? Is there any question before we wind up? Any question before we wind up? Any question before we wind up? I think there is none. So let's stop at that point. Have a nice weekend. See you next week on Tuesday as we move to another topic. Remember that this is an investment. Either an investment in shares or basically an investment in what? An investment in debt instrument. Yes. So I want us to have a discussion on this financial liabilities before we take a short break, and then we come back to do a question. So if we are done basically with what we have out there, I think we can move and discuss on this. Yes. So financial liability. What is a financial liability? A financial liability, basically, we can say that this is a contractual obligation. This is a contractual obligation to do what? To pay cash. This is a contractual obligation to do what? To pay cash. So here, an entity or basically a company has entered into a contract, and in that contract, the company has an obligation to pay what? To pay cash. Now, generally, financial liabilities, these are the debt instruments which have been issued by the company. So these are the debt instruments issued by who? By the company. The debt instrument, e.g. debentures, e.g. bonds, which have been issued by who? Issued by a company. Issued by who? By a company. So therefore, if you come across a question and you're told company X here, for example, issued debentures, the company X issued bonds. So to this company, this is a financial what? Liability. And therefore, you need to differentiate between financial assets and financial liability. So financial asset is whereby a company will have invested or a company will purchase debentures or what? Both. So if you invest, you purchase both or debentures, to you is an asset. But if a company issue debentures or if
we are recording, so now we have missed something. But no problem. So we are saying, so maybe just a recap. So we have said time value of money. It is that the fact that over time the value of money changes. The value of money does not remain the same. And I'm saying, assuming here now that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this, it may be, if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount was be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth. What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you are supposed to compare the two, you cannot compare when they are not in the same form. You are supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, If you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah. But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear. A lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus R power n. Principal times 1 plus R power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No, equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus R power n. This factor here, this factor 1 plus R power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus R into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, that there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value, we are saying, is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000, that is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. Alice, repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. Let's say 100,000. No, will that give us? No. No, that is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2 The figure that you'll get here, you bring it here. Then you continue, but that will not apply in this case because we are only investing one. So you can continue, you grow by that rate, So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you've seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus R power n minus 1 over R. That's how we get the future value of an annuity. 1 plus R, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus R into brackets power n minus 1 over R. This factor here, the factor 1 plus R power n minus 1 over R is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do you have an illustration there? From the above example, there is a statement that says no. We have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%. Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. $322,080. $322,080. Another person. $322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period, period, 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 60. 60. 60. 60. At the end of each period, this person is investing 60. So here you say 1 plus R power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus R. 1 plus R. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call okay, fine, Alice, 080. Okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year. At the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said, this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that you invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. 1 plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that. And then we have an illustration So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they are saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus r power n minus 1 over r times 1 plus r. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, The reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Eh? Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we are saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. On 76 to 34 point you can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352, 140, 493, 140, 493, 125 for 40, 125 for 40, and 112,000. So get the sum. $711, $519. $711,519. Now the reason why we are doing these two methods, this is very short. This is like a shortcut. But we are doing this method so that you can get the concept. Because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting it is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting. Or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum still the same thing as we've said. An amount that is paid or received once is what we call a lump sum. So how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative n. 1 plus R power negative n. So look at this factor now. Look at this factor now. Under compounding, we were saying power n, positive n, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. So get the difference. Present value for lump sum is equals to future value times 1 plus R power negative n. So where this is future value, R is we said is the required rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus R power negative n, the factor 1 plus R power negative n, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. And this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, R% power n. Present value interest factor, R% power n. So let me share with you the present value interest factor tables. The present value interest factor tables. Just check on your WhatsApp. Check on WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting. I have shared. Once you receive it, kindly let me know. Once you receive it, kindly let me know. I want to show you how we read. Okay, but that one we're going to do in an illustration. We're going to do in an illustration. So what do you need to add here? Nothing. Nothing. So when we are using tables, we say present value of a lump sum with tables. We say present value of a lump sum is equals to future value times present value interest factor R% power n. So this factor here, this is R, this is R, this is R% power n. Present value for lump sum is equal to future value times present value interest factor R% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. We have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount did you receive today to be indifferent using, that is, using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus R power negative n. Power negative n. So present value is equals to 172,800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000. 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor R percent power n. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we're together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now, in that table, in that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for n periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row, we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like, for example, we have periods upper. We have 1, 2, 3, 4. Then we have these percentages, 1%, 2%, 3%, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage. Or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there. At 20%, period 3. 20% at period 3, you're getting. Write the factor there, 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787. 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99.36. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what you're supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value, present value of an annuity. Present value of an annuity. present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus r power negative n over r is called present value interest factor of an annuity r% power n. Present value interest factor of an annuity r% power n. Thus, present value of an annuity is equals to the annuity times present value interest factor annuity r% power n. R% power n. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down to row 3. Not 3, but count 1, 2, 3. At 20%, you should go up to 0.5787. You'll see, yeah, that's how we read this thing. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember, this formula here, this formula that you're seeing here, this one, it gives us the same figure as what we have in the tables, rounded off to 4 decimal places. You round this to 4 decimal places, you're supposed to be getting the same figure. So nothing different. So let's see an illustration. An illustration present value of an annuity. Yeah, we have an illustration and a present value of an annuity. An illustration and a present value of an annuity. And they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. What is the maximum amount would you be willing to pay for that project if the required rate of return is 10%? So Let's do that. Now, when you are ever told to determine the maximum price to pay, and I saw that kind of a question in the last sitting paper. Every time you are ever told to determine the maximum price to pay, the maximum price to pay for an asset or for anything must be equal to the present value of the expected benefits. Must be equal to the present value of the expected benefits. Maybe we can have a look at, do you have your past papers? Let's look at the past papers. Just open your past papers. I show you that question. Past papers. It must have been question 2 or 3. Open your past papers. The August 2025 paper. The August 2025 paper. August 2025. Question 4A. Not sorry, not that one. Now, yeah, question 4B. Question 4B. Question 4B. If you're there, you will see that required is advise an investor interested in Mara Limited on the maximum price to pay per share. So maximum price to pay, we say maximum price to pay is equal to present value of all expected benefits or cash flows. Benefits or cash flows. So if it's a share, to get the maximum price to pay for a share, it is the present value of all expected dividends from that share. If it is an asset, like for example, you want to buy a motor vehicle for commercial purposes, the maximum price that you're supposed to pay for that motor vehicle, it is the present value of all what you're expecting to earn from it. So that is what this question says. So back to the question. So what I'm trying to say is that some of these things you don't need to forget. This is something that I repeated a number of times last semester. And you see it came in the exam. So maximum price to pay, kindly note, because it's a concept that will keep on applying. Back to our illustration. So they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. Annuity is shillings 1,000. Number of periods is 4 years. 4 years. And they're saying, what is the maximum amount would you be willing to pay for that project if the required rate of return is 10? R is 10. R is 10%. So maximum price to pay, this is present value of annuity. This is the present value of our annuity. So present value of an annuity, is equals to the annuity times 1 minus 1 plus R power N over R. So our annuity here is 1,000 times 1 minus 1 plus 1 minus 1 plus 0.1 power negative 4 over 0.1. So shillings. Get the figure. How much are you getting? That 169.87. That 169.87. Another person. That 169.87. Another person. That 169.87. We are waiting for another answer. Someone else kindly. Okay, let's assume that is the correct answer. Or present value of annuity is equals to annuity times present value interest factor annuity R% power n. So here 1,000 times present value interest factor annuity 10% at period 4. 10% at period 4. So 1,000 times. So now let's go back to the tables. Let's go back to the tables. So thank you, Tambua. Back to the table. We are using the lower table now. We are using the lower. This is an annuity. Go to 10%, drop up to period 4. Go to 10%, drop up to period 4. 10% you up to, oh no, just give me the factor. 10% at period 4 in the lower table. So in the lower table, so I'm saying 3.1, saying 3.1699. 3.1699. So you can see we are getting the same thing. That 169.9. That 169.9. I want to believe you've all been able to read the table. Yeah? Okay, fine. Next, we look at present value of annuity due. That is next time. We'll pick from that point next time. Number 3, present value of annuity due. Present value of annuity due. I believe we'll be able to look at all the factors, then we proceed to something else. Now, as I said, this is very important. Make sure, and that is why I don't want to rush. I do not want to rush because this concept is very important. If you get it at this point, you will have no problem going forward. You'll be very much okay. So make sure you repeat these concepts, do the illustrations that we've done. In case of any question, you will ask. Any question for now? Any question before we close? Any comment before we close? Yes? Okay, fine. If no question, we are going to close at that point. See you on Saturday. See you on Saturday. And enjoy, or rather, have a good night. Have a good night.
Yes, so in today's class, I want us to look on this topic, and the topic is the accounting for leases, minimum lease rentals. Minimum lease rentals. So therefore, that is the meaning of a lease. Is a contract where the owner of the asset, who is also called the lessor, will give the right of use to a person who is called the lessee, and the lessee here is automatically expected to pay some periodical payments to this person, which are known as the lease rentals or the minimum lease rentals. Now, leases basically are accounted for by these two parties, the owner of the asset and basically the lessee, in accordance with the International Financial Reporting Standard number 16, of which this basically is a new standard. Reason being, if you go through some of the past papers, you'll be able to come across some questions which are quoting IAS 17. Previously, leases were accounted for in accordance with the International Accounting Standard number 17, but basically this standard has been scrapped, or in other terms, we say that it has been superseded. It has been superseded by IFRS 16. Superseded means that this particular standard has been scrapped, has been done away with, and basically replaced by what? IFRS 16. Is important for me to mention that because you'll come across some questions maybe from past papers which are quoting International Accounting Standard number 17. That standard is no longer applicable.
Different perspective. So being in a group helps you to understand other perspectives that you are not able to know. So that's number one. We talk about what? Diverse. So the community consists of members from different departments or backgrounds, allowing for a variety of opinions which lead to what? Well-rounded decision. Means when you have diverse opinions, then basically it means that you can now look at issues better, and then what? Make good decision, as opposed to you alone making decisions. Then number two, is improved accuracy. Why? Because you make decision what? Collaboratively. You can never go wrong with a group. If you have people who are very objective, then basically a group decision making becomes the best. So that collaboration increases the chances of identifying potential flaws or risks, leading to a more informed and accurate decisions. So we talk about what? Talk about collaboration. Means because you have experts in different areas, that means that when you want to make a decision, all of them will have their input, and that their input will lead to you making what? A very accurate decision. The third benefits of group communication making is basically increased acceptance of decisions. If I make decision alone and then I go to a group of people and tell them that this is what I've decided, they'll ask me, you decide as who? But when I say that this is what we decided, like for example, this is what we've decided like as a country, but this is what Kenyans have decided, you will rarely refuse that decision. This is what we have decided as a class, as a company. So basically, when group decisions are made in terms of a group, then basically its acceptability rate is higher than what decision made at individual level. Number four is what? Pooling of experts. Sometimes we will make what we call a multi, or we call it a group with different experts. How do you call it? There's a name that we call that group, a group that has got a committee that has got different people from different departments. You have a marketer there, you have a procurement professional there, you have a lawyer there, you have an HR expert there, you have a production expertise there, you have a company engineer there, you have. So basically, when we talk about pooling of expertise, so Some decisions don't need only one expert. They need, for example, they need an input from the accountant, an input from procurement officer, an input from the marketer. So basically, when you can form a committee with different experts. We call it a multi-sectoral committee where you have people from what? Different sector or sections, and then they come and what? Make a committee. And that committee basically, if you're deciding on something, you'll have experts from all over. So basically, their input will go to what? Help you make what? A good decision. Number 5 is checks and balances. So group decision making helps to counterbalance individual biases or authority dominance from promoting fairness and accountability. Now we talk about checks and balances. Sometimes there are what's called individual bias. Me as an individual, my decision is going to be biased based on my perspective, my experience, other things. But if you sit down as a group, then basically we are able to discuss even the biases that come out of my decision. The group members are able to scrutinize them. So basically, I'm going to be objective, not subjective. Anytime we have biases in decision making, we are becoming subjective. So with other people are going to scrutinize my decision so that's number 1. And then also talk about what? Authority dominance. There are some people that normally believe that they're the people that decide things. I'm the manager here, I decide. So with group decision making or with committee decision making, basically, we eliminate that aspect of what? Of authority dominance, that you're the person that makes decisions. So basically, it encourages collaboration, so that even the manager feel like is also part of the operation. The next question here is asking, identify 5 ways in which management could overcome employee resistance to change. This question, as we have met it again and again and again, and you may even meet in exam. The questions repeat themselves sometimes, basically. So that identify 5 ways in which management could overcome employee resistance to change. We said that sometimes employees resist change. And there are reasons that there is change. One of the reasons, the major reason is what's called fear of unknown. Sometimes decisions can be made, or some changes can be made, which can even render you jobless. Some of them can lead to your job being taken away. Some can lead to your salary going down. So some can lead to a lot of things. Some can lead to relocation. You'll be used to Nairobi. You don't know you're going to Wajir, you're going to Kajiado, you're going to Kapedo, to Turkana to do work there. So basically something. So because of the fear of unknown, some people can work. So let's look at some of the ways to what. As a manager, you can be able to overcome change. This question we are several. So this is repeated. Number is what? Effective communication. You tell me why the change is important and why. So let me know. Sometimes we resist change out of ignorance. But if you're able to communicate with me, elaborate for me, make me understand, then basically I'll be one of the people that are going to fight for the change to happen. So clearly explaining the reasons for change and the benefits of this help in reducing what? Misunderstanding and anxiety. So explain to me, in terms of my job, after the change, what's going to happen to me? If you explain and find that, this thing is just for the help, for the betterment of my job and the company, and there's no harm in it, then basically we'll be able to just support the change. Number 2 is employee involvement. That's very true. Employees want to be part of the changes that we make in the company. Let them be in the committees. If you want to bring a committee of a certain change, let your employees be among the committee members. Let's discuss issues. Go for some meetings, long-term meetings, maybe for 3 months, and then they understand, and then basically it's able. So when employees are part of the decision, basically they know, they understand it better. So that means what? They're able to basically support it, so the change. Number 3 is training and support. That's very true. Some changes come up with the new things that maybe your current employees don't have. They may require some new skill that the current employees don't have. So what happens? Before you implement the change, train them on the new skill required once the change is implemented. So basically, that's very important because some people fear that their job may even go, because if you bring a system that I don't know how to use, and I'm supposed to work, then what happens? I'm not going to meet my objective, and then basically I can even be fired. Now, first what? Addressing concerns. Sometimes when you propose a change or you bring a change, employees will have their concerns concerning the change. So that's why as a manager or as a change maker, you must be able to come up with ways of addressing. If somebody comes up with an objection to the change, And they say, Mimi, I'm not supporting this because of it. Can you be able to what? Can you be able to address the concern? Tell them that, okay, I understand your concern, but this change is not going to harm you in a particular manner. This is what's going to do. So basically, by addressing the concern, you're able to what? You're able to prevent, you're able to what? Reduce resistance to change. And then number 5 is what? Is incentives and rewards. So offering recognitions, rewards, or incentives encourages employee to embrace change positively. You have like, you can say that word, the people that help implementing them, the facilitators basically, those who are facilitators of the change, they will be recognized by the company, they will be rewarded, or they will be what? Given some incentive. So that is very, very important that you look at that. I can see somebody has written something. Let me see what has been written down so that we can be able to help. Then incremental implementation, that is very true. We say that bring change in piecemeal. Don't just come and say that by tomorrow things are changing. No, bring change in piecemeal. So that this change we are starting, we want to implement this change departmental-wise. We start with the HR department, we go, by the time we are in May next year, the company needs what? All of them needs what? We need to have what? A complete change. Don't bring what's called instant changes. That one can bring problems. So what do you do? Implement it incremental. Incremental means you do it in stages, stage 1, stage 2, stage 3. So, or reward in phases, phase 1, phase 2, phase 3. So that what people even see how good it is before even it reaches their department. That's also good. Buchi, thank you for that. And also what? Strong leadership. You must have leadership who are people who are able to stand firm and explain to employees the need for the change and look at the interest of the company as opposed to what? Interest of individuals sometimes. Very, very true. And then follow the change management process. Yes, you can use different philosophies or different procedures in that one. So if you follow those processes well, then basically you're able to ensure that what? The changes. So those are other 3. So we were asked about 5, but we have been able to what? Come up with around 8. That means at least now we are very much armed. If you're able to have 8 points instead of 5, that is a very good sign that we are now very much armed for the sake of the exams. Now, the second question, another next question says, explain 5 uses of business plan. This one also, we have done it before. If you look at the past papers you've done, then you'll find uses of business plan as one of the major questions that you've done. Now, a business plan is basically a proposal of what you're going to do. A plan is what you're going to do. So basically, you can call it business proposal or a business plan. It tells us basically what you want to do. That's called a business plan. Now, number 1 is what? Securing funding. Sometimes there are people that have had great business ideas, but they don't have funding. So what do? They develop a very good business plan. They develop a very, very, very nice developed business plan. And then they go to these commercial banks, whether Equity, KCB, Standbank, or Standard Bank. They go to those banks and then they book a presentation with the top level management or the management of the bank. And then they go and present their business plan. And if the bank sees that this guy has got a good business plan, then basically they'll finance you. So you have 0 money, but you have a very good idea. And if they see practicality in that business, if they see that this is able to be able to get return on investment, then basically they'll be able to give you finances. So that one happens to the banks or other financials. There's been a problem called Lounsden. I don't know if it's still there. There's a problem called Lounsden in NTV. Is it still there? Whereby you see some people with business ideas go and present them before some of the managers or people, investment experts in KCB, and then they are being financed. Then in the global perspective, you used to have something called Shark Tank, whereby even Donald Trump used to be a panelist there. Those people with a lot of money. So you go there, present your idea, and then they say that, okay, we are giving you money, but we want to have 40% stake in your business, but the finance. So basically, those are aspects. Now, number 2 is what? Guiding business operation. Anytime you have a plan, when you talk about this is my plan for the day, then you have to work with the plan. So basically, a business plan will guide business operation because everything you do it as per the document business plan. So basically, you're able to ensure that what your operations are guided. So it serves as a roadmap outlining goals, strategies, and timelines which guide daily and long-term decision making. So basically, you don't work against things, you work as per the business plan. And then number 3 is risk measurements. Sorry, performance measurements. That's very true. Means in your business plan, you even have what's called projections, cash flow, projected cash flows. You have projected profits, projected balance sheet, and all. So basically, with those projections, if you do business in the first year, you can compare with what you had projected in the business plan and see whether you're moving in the right direction, or if you miss it, why did you miss it, basically. And then our fourth is what? Risk management. So in the business plan also, you must have something called risk management plan. Business plan has got several sections. You have the introduction part, bibliography or the summary. We have the business plan, financial plan, management plan, operation plan, financial plan. And so basically, we talk about risk and even risk management plan. So in your business plan, you must also be able to predict some of the risks you're likely to face in the business. Because if you go to present to these banks concerning a business, they'll ask you, what are some of the risks that you identified and how are you going to deal with them in case they come? If we finance you and then these risks come out. So basically, you must have what? A risk management plan. So that what? Any risk that may come, you already have a way in which what you want to deal with it. Number 5 is what? Is attracting strategic partners. There are people that can come on board in your business to even finance you because of what? They see you have a very practical and a very, very innovative business plan. So they want to be part of it. So basically, some people have been able to get partners to partner with them because of what? Out of the good business plan they've been able to what? They've been able to have. That is very, very important or very, very important. Now, question 2. Question 2 is asking, summarize 5 responsibilities of a project manager. Today, you are a project manager. And last week we said that we were doing a questionnaire I think it was on Thursday, where we said that what are the advantages of taking tasks given to you as a project? So anytime you're given an assignment to do, look at it as a project. And if you look at it that way, then basically you'll be able to what? You'll be able to perform better. Now, let's look at this question. Summarize 5 responsibilities of project manager. You'll be given a project. You see that a project is a temporary endeavor with an objective and a starting date and an end date, basically. Now, a project manager, number 1 is what? Planning and scheduling. You have to plan for the project, and schedule means you have to say what is supposed to be done today. You schedule your activities. So as a project manager, you're given, for example, construction of road as a project. You must have what's called, you must plan what's supposed to be done, and then also schedule that. For example, how after 1 week, where are we supposed to be? Or what should you do in the first day, second day, third day? You schedule those activities. Number 2 is what? Resource management. You've been told that, okay, this road from here to here is costing taxpayers 100 million. That 100 million will be given to you as per the budget. So it's upon you to ensure that what? You manage that resource, which is, so you, as a project manager, you'll be required to manage financial resource, which is one resource, human resource, and even what? Capital resource, and even time as a resource, you manage them. Then number 3 is what? Monitoring and control. So tracking progress, managing risk, and ensuring the project stays within scope, budget and schedule. So basically, you're able to what? Monitor, ensure that everything's done the way it's supposed to be. Then another duty or responsibility of project manager is what? A team leader. As a project manager, the buck stops with you. If the project fails, you'll be the first to blame. If the project fails, so basically, you're a team leader. You lead all the teams, different teams doing different activities within the projects. And then number 5 is what? Communication. As a project manager, basically, you have the responsibility of what? Communicating to the project team, communicating with the stakeholders, communicating to anybody within the world, anybody with an interest in that project. So communication. So keeping stakeholders informed of the progress, changes, and issues throughout the project life cycle. So it's upon you to your information is supposed to provide relevant information to the stakeholders involved. Next question here is asking, explain 5 reasons why project management is important. Now you see, We have talked about just a project management. So this paper was very nice. If you are good in project management, you score 10 marks very easily, because the previous one, how many marks was this previous one? This question was very fair. I don't know what has happened. What has just happened? What has just happened? Just a minute. Okay, good. So, reasons why project management is important. First, what is improved efficiency? So, structured planning and execution leads to what? Effective use of time and resources. So, basically, project management ensures that what? The resources that are given to the project are used in the most efficient manner. Number 3 is what? Clear focus and objectives. Now, if you are good in project management, you ensure that whatever you do it to ensure that what? At the end of the day, you should be able to achieve the project objectives or strategy. Number 3 is risk mitigation. So it identifies potential problems early and provides mechanism to manage them. So as a project manager also, you do what's called risk management. So you should be able to what? Identify some of the potential risks you are likely to face in the project, and then come up with what? Some mitigation or some management strategies of those risks. Very, very important that you look at that. Then number 4 is budget control. Very true. Budget is basically, when you talk about a budget is a financial control tool. When you're budgeting means you say that this is the amount of money I have. Now this is how I'm going to use it. Without a budget, you'll do what we call impulse purchase. You purchase things you see, not things you need. There are things that you want and you don't need. There's something, the difference between a want and a need. So if you don't have a budget, then you buy things you want. You should be able to buy things you need first, then things you want can now come later. So the through constant monitoring, it helps in keeping the project within the allocated financial resources, means what? Within the budget. Number 5 is what? Stakeholder satisfaction. So successful project delivers increased confidence and satisfaction of clients and stakeholders. So basically, with good project management, you'll be able to meet the objective or the goals of the project, and all the stakeholders are going to be happy with the project. So that is the 5 reasons why project management is very important for organizations. Reasons why project management is important for actions. The C part of that question is asking, explain 5 factors that may influence the level of compensation and benefit package offered by an organization. That means that question is just asking, is in simple terms, is asking what factors determine how much you're paid by the company. That's what they're asking. Number 1 is industry standards. So there's also what? The industry standard whereby a lawyer who has come out of school or a new graduate, how much? So there's another which one is in the industry. So basically, if you are new in the industry, they look at the standards and then they pay you as per that one. Number 2 is what? Organizational financial capacity. If a company is making good amount of profit, then basically they are likely to pay you highly than a company making less profit. So basically, the more profit a company gets, the more they may be able to make the life of their employees better by paying them increasing by having what's called a payment increment or salary increments. Number 3 is job complexity and what? Responsibility. So it depends. If you have a complex job, you are likely to pay more than somebody with less complex jobs. So basically, so jobs requiring high levels of responsibility, scale, or risk typically attract higher compensation. Now look at, for example, being a doctor. You know, a doctor, there's what's called a high level of responsibility. You make a small mistake, somebody may lose their life. So those ones. So basically, look at that. Then number 4 is what? Employee performance and experience. Sometimes you're paid based on performance, especially in the marketing sector. So talk about that. We talk about aspect of what? Of performance and also what? Experience. So that you've seen it happen that somebody with many years experience are normally paid more, even at the same job if they come to your company, that's how many years experience? 10. Then you see them being paid more than somebody at the same level because of the experience. Then number 5 is called labor market conditions. So what are the prevailing conditions in the labor market? So high demand for certain skills may push employer to offer attractive packages to secure top talent. So sometimes talk about what? Talk about market condition. If you have less accountants in the market, and there are so many companies that need accountants, then accountants will really choose that mimi nitaenda kwa kampuni ya pesa mingi. So I'll go to the company that will offer me the best package, the best employment package. So that's another factor that determines. So talk about labor market. And even I think even the industry, this one should not be, is not here, but basically industry. Which one do you think is another factor that determines how much somebody is paid? Apart from this one listed down, I think the industry, there's some industries that are paying well. What else do you think are some of the factors that determine how much somebody is being paid? I think even wage bill is called talk about what? Talk about minimum wage requirements. All those ones will determine how much somebody is paid. So which other factor do you think determines how much somebody is paid in a company? The floor is open. Anybody with another factor that determines how much somebody is paid in a company? What about academic qualification? Somebody with a master's or a PhD in a particular field. Management level means where you are going to. That means what? We talk about the level you're coming at. Is it mid-level, lower level, higher level? Yes, well, that can happen. I think even academic qualifications, sometimes when somebody has got some qualifications, you feel very awkward to pay them less money. You want to justify. That's one. Any other one? Terms of contract or some terms of payments? Some are called paid wages, some are paid salaries. So basically, we have so many, but those ones are few of them that we've been able to list. Next question. The next question asks, explain two limitations of budgeting as a tool of control in a company. So basically, a budget is a financial control tool. When you give somebody a budget, means what? You have to spend the money given to them as per the budget. So basically, it controls your spending. So you're being asked, what are some of the limitations of budget control? Number one is rigidity. If I give you a budget, then actually work as per the budget means you don't now not think. There's no thinking here. You are rigid. Rigid means what? You have to work as per the budget. And you may have another idea of what to do. But basically, because you have a budget, you have to work as per the budget. Number two is what? Inaccurate forecast. So budgets are based on assumption that may not hold true. Lead to what? Poor decision making. So sometimes in a budgeting, we may use the current market rates. But things can happen within a 1 month. Basically, there can be an occurrence in the market that may trigger the price to start increasing. Maybe some speculations on issues or on future supply or demand of certain. So basically, we make budgets based on forecasts, but sometimes we may have wrong forecast or may forecast wrongly, and then tomorrow we find out what we either have less money or we had budgeted a lot of money instead of what just a less amount of money. There's somebody who has written something here. I want to look at it. Or government regulations. That is good, Gilbert, and I think that's good. That's another factor that what determines what determines basically level of payment. Union can now advocate for what? Higher pay sometimes. Now, question 3B. 3B asks, identify 6 biases that could compromise decision-making process. This question we have done it severally, not once. This question on biases, this one we have done it. So we'll just still look at it, but this is a question we have done. So there's something you're seeing that questions keep on repeating themselves. So let's look at some of this bias. Number one is called confirmation bias. Tendency to seek information that supports pre-existing beliefs and ignore correlation beliefs. So basically, this one means what? Talk about confirmation bias means what? You make a decision based on what? Pre-existing belief. My belief. This is what I believe. So and I need to make a decision on a some issue. Then look at my belief and then make a decision. If I'm a Christian, if I'm an accountant, if I'm a programmer, so this is what? Based on my belief, I make a decision. Number two is called anchoring bias. So relying too heavily on the first base of information encounter. So the first information I was able to get is what I use to make decisions. Any subsequent information, I don't use them. I depend on the first information. That's called what? Anchoring bias. So you anchor your decision based on what? On the first information that you got. The next one is called overconfidence bias. There are people that are very overconfident. They believe that what? They know they are all know it all. So they can just make decisions without any problem. So that is also another aspect that we have to look at. We talk about overconfidence bias. So believing one's knowledge and prediction are more accurate than they are. So sometimes you can be overconfident for no reason. Sometimes you may find that what? You may think you know and you don't know. That's another bias. Then you have something called recency bias. So sometimes you have a bias that, well, this one worked last year, this one worked last month, let me use it. So giving undue weight to recent events or information. So basically use the recent information or recent event. This is what we did last month and it worked. So I'm going to still use it again this month. So it may backfire because conditions that were there last month and this month may differ. That's called what? That's called recency bias. Means you base your decision based on what? On the recent occurrences. Then you have something called availability heuristic. This is also another bias. This one doesn't have the name bias, but it's also one of the biases you're likely to face. So judging the probability or events based on how easily examples come to mind. So this means what? You can be able to support what you're saying using what? Some examples. Then you have what's called groupthink. Groupthink, we said that this is a case whereby you want to be part of the group decision. So you don't want to what? Come up with a different opinion. So groupthink means what? You don't want to make the people in the group feel like you are contradicting their opinion. So you accept things that majority accepts, even if you have a contrary opinion. So that's called groupthink, whereby you don't want to go against the group decision. So you support them, not because you like them, but because you feel like what? You don't want to be the antagonist in the group. That will say that we want to chelewesha hapa. So basically, that's called what? That's called an aspect of what? An aspect of groupthink. Somebody is reading something here. When do you want me to explain what's called the recency bias? Recency bias basically means that you make decisions based on what had worked recently. Like last month, last month we made this decision and what? It worked. So I believe that because it worked last month, it will work this month. That's called recency. It means what? You look at what decision that you made successfully recently, and that's what you make again. That's called recency bias. I don't know if you answered, Wendy. Are you answered? Good. Then those are the biases that you talk about. That question has been repeating itself several times. So be very careful with that such kind of question that keep on repeating themselves. Next question is describe 5 marketing management philosophies. So basically, we are talking about the marketing philosophy. This is also a question that has repeated itself. We talk about the marketing philosophy. Some people call them what? Marketing concept. You can call them marketing concepts or marketing philosophy. So let's look at some of the philosophy or concept that we have in marketing. The first one is called the production concept. So these are basically a philosophy or a concept. These are basically aspects of theories. You can still go and criticize the theory or the concept. So the first one is called the production concept or the co-production philosophy. So assumes customers prefer that products that are widely available, affordable, hence focus on mass production and things. So basically, this philosophy believes that customers will buy what they see. So you work as a company to make the products available. As long as they are available and affordable, customers will buy. That's the philosophy. It's about availability. That's why you see even those in the streets, they're selling hawkers. They make items available. You will not plan to buy a shoe, but then you see a shoe and then what? You buy it. And you see it's affordable. So first you see it and then you ask how much you're selling, then you end up buying shoes and you didn't even plan for. That's called what? That's called production concept. So you produce in large quantity and then you make them available and customers will buy. Because sometimes we are visual beings. We buy what we see. Now, number two is called the product concept. This basically says that what? Customers will buy products with superior quality. That's what. So emphasize product quality and innovation, believing customers value superior features and performance. So basically, this is about quality. So this one says that what? Customers will only buy products which are of good quality and innovative features. So if you're doing production, produce products which are very quality and have got what? Innovative features basically.